Global Finance, Topic 10, Currency Options and Hedging, copyright Lou Gaddis. In this topic, we're going to compute the costs, payoffs, and profits of options and understand how they're used in hedging. First of all, we'll start off with talking about what a currency option is. Currency option is the right, but not obligation, to buy or sell a currency in the future. The contract to buy a currency, foreign currency, we call it a call option. The option to sell a foreign currency is called a put option. You have the right, but not obligation, to buy or sell these options over the life of the option. So, for example, you might have a 2-month option to buy euros at $1.25. All right, that would be a call option for 2 months. Now, the exercise type could be American style or European style. An American style option, for example, if you had that 2-month option to buy the euro, means that every single day from the time you buy the option until the time the option expires, you have the option to buy the underlying asset and pay the option price, also called the strike or exercise price. A European option, you only have the right to exercise the option, in other words, to buy in a call or sell in a put, on the actual expiration date of the option. Now, to have the option to walk away, right, to have that right but not obligation, you're going to have to pay someone to have this option to sell or buy a currency but able to walk away. So when we talk about the prices of options, there's 3 different prices that get talked about. There's the exercise or strike price of an option. So just like in forward and futures contracts, we talk about the forward or futures price, the price which you buy or sell. For an option, you have the exercise or strike price. So for example, if I had a call option to buy euros at $1.25, I'll call that price, $1.25, the exercise or strike price. Now also in an option, unlike a forward and futures contract, you have to pay a price up front to just have that option. That price you pay up front is called the premium, the cost, the price, or sometimes called the value of the option. And this is paid in advance by the buyer of the option to the seller of the option. Now you also have the underlying spot price of the underlying asset, so the underlying asset spot price. So if, for example, if I have the call option to buy euros at $1.25, that $1.25 is the exercise or strike price. Now that is not the current spot, or not necessarily the current spot price of the euro. We'd call that the underlying spot price. In options, we talk about moneyness. We talk about options either being at the money, or in the money, or out of the money. An at the money option says that the strike price or exercise price of the option is exactly equal to the spot. All right, so say you had a $1.25 strike price to buy euros next year, and the current spot price of the euro happens to be $1.25. We call that an at the money option. An in the money option is an option in which if you exercised, you would make money. So for example, if you had a call option whose current strike, say $1.25, is less than the spot price of the asset, say $1.30. Say that's my spot and this is my strike. Now this is an option that's going to be very valuable to exercise, because I could exercise the option, buy the underlying euros at $1.25, and sell them into the spot market at $1.30 and make 5 cents. So an in-the-money call is what you have a strike that's less than the spot, because you have the ability to buy an asset at a discount to the spot. Now the in-the-money put, on the other hand, has a strike price that's greater than the spot. Remember, a put is an option to sell the underlying asset. That's only valuable if you can sell the asset at a greater price than the spot market. So the example of an in-the-money put would have a strike price of $1.25, but the current spot price of the asset is, say, $1.20. So this is an option where I can sell euros at $1.25. Where I'll get them is I'll purchase them in the spot market at $1.20, and then I'll sell them for $1.25. So this is an in-the-money put. Out-of-the-money options are the opposite of in-the-money. Those are options which you would never exercise, because if you did, you'd lose money, right? Why would I exercise a call to buy an asset at above market prices, or why would I exercise a put to sell an asset at below market prices? This is a really old chart from Wall Street Journal, but it gives you all the basics you'll see on the internet today. This talks about the prices of options on the Philadelphia Exchange. So we have pounds and yen and Swiss franc, but let's look at the euro for now. Now notice this is a much busier chart than looking at forwards and futures, because one, there's a price for a call, and two, a price for a put. Remember, a futures contract, the buyer and the seller sign the same contract. Well, now we have different contracts. A call option is a price to buy, and a put option is a price to sell. We also have, say, different delivery months, just like futures. However, for any particular delivery month, you could have more than one strike price. So, for example, in this example, there's a 92 strike call and put that is due in December. There's a 90 strike December contract and an 88 strike December contract. And the reason why you can have more than one strike price for each delivery month is, unlike forward contracts in which there's no money exchanged, for a forward contract for a particular month, there can only be one price which parties agree is a fair price. Let's exchange at this price. I won't pay you, you won't pay me up front, but it's a fair price to pay for euros a year from now. However, once you open up a market for options and you say, well, you pay me a premium, give me something up front, and then you can have the right to buy or buy for a call or sell for a put. But once you do that, well, you can start negotiating that, say, well, all right, can I pay you 5 cents to buy the euro at 90 cents, but I'll pay 1.6 cents to buy the euro at 88 cents. So the idea is, once you open up the idea that you will pay up for, say, a lower strike for calls or a higher strike for puts, you can just have a whole array of different strikes. So let's look a little more at this euro one. On the Philadelphia Exchange, each euro contract, call or put, is a quantity of 62,500 euros. So this 90 strike, and that's 90 cents per euro, that comes due in January, is selling for 1.25, and this is cents per euro. So it's selling for 1.25 cents. So this contract, if I want to buy this contract, it gives me the right to buy 62,500 euros in January for a price of 90 cents. I'll pay 1.25 cents times 62,500 euros. I'll pay $781 to the seller of the option. Now I own this option. I now, if I choose to, exercise it and buy 62,500 euros at 90 cents each. Or in other words, I'll buy 62,500 euros for $56,000. Now, it gets a little more confusing on the yen. Here's the yen, Japanese yen contract. You can see the underlying price of the yen is 92.53 that day. Each contract is for 6.25 million yen. So here's a December. This is a put over here. So these are puts. This is December put to sell the 6.25 million yens for a price of 91 yen per dollar. Now the price of this contract is 2.05. Now look at right here, hundredths of a cent per unit. In other words, per yen. So let's write 2.05 cents. All right, so that's how I'd write 2.05 cents. But this price is hundredths of a cent per unit. So if I divide that by 100, I get 0.000205. That's the actual price per yen. So if I want to buy this contract that gives me the right to sell yen at 91, I'll pay 0.00205 times 6.25 million yen, the yen cancel out, right, because that's a price per yen. It'll cost me $1,281 to buy this put option to sell yen for 91. Notice if I want to sell yen at 89, it's a lot cheaper. It's only 11/100ths of a cent. So this contract, if I buy this December 91 strike put, I pay $12.81. Now I have the right to sell 6.25 million yen at 91. So I can sell 6.25 million yen at $68,000. So let's talk about option costs and payoffs. The cost we just covered. It's just the premium per FX unit times the quantity of units. So that was doing this calculation here and this calculation here. That tells me the cost to buy the option. Now when we talk about options, there's also, besides the cost, there's the payoff. Now the payoff of the option is the value of exercising the option. Now since this is an option, both calls and puts, if the option is out of the money or at the money, which for a call means that the spot price is below the strike, or in other words, you have a high strike price, the payoff of the option is 0. In other words, I'm going to walk away. I'm not going to choose to exercise a call option whose strike is above the market price. Because why would I buy at a high strike when I can just go to the spot market? So the payoff is either 0 if it's out of the money or at the money, or it's ST minus X if it's in the money. All right, so I said if it's out of the money, we know it's, or if it's at the money or out of the money, we know the payoff is 0. But if it's in the money, I'm going to exercise the option. I'm going to buy the asset at X, and then I'll immediately sell it into the spot market and get ST. So I'll make ST minus X. So how we write this mathematically is the payoff of a call is the maximum of 0 or ST minus X. In other words, it's 0 if it's out of the money or at the money and I walk away, or if I exercise, I will get ST minus X. So we'll show how that works in a minute. Now, if it's a put option, again, if it's out of the money or at the money, my payoff is 0. If it's in the money, I have the option to sell the asset at X. If X is greater than ST, which means I'll buy the asset in the spot market at ST, the price at the expiration of the market of the option, and then sell at X. So my call option and put option cost is just the premium times the quantity. My payoff depends on whether it's a call or put. It's going to be either 0 or ST minus X for a call and X minus ST for a put. However, when I talk about the profit of the option, it's the payoff minus the cost. And one point to talk about here is the cost of the option. Once you pay for the option, you then forget about it when deciding whether or not to exercise, because this is a sunk cost. So let's do a little problem. Say you buy 5 130 strike calls. So let's put that as the strike price X. They're calls, a quantity of 125,000 euros per contract, but we have 5 of them, so I'll make that little q. And the cost of the option is 5 cents per euro. What is your profit if the euro is selling for $1.15? So that's my spot price at the maturity of the option. So if you want to try to work on that and pause it, go ahead now. Now there's 2 ways I can think about solving this. One way is kind of thinking about it and just decide whether or not you're going to exercise. So if I want to just think about that way, would I exercise an option to buy euros at $1.30 when I could buy them in the spot market at $1.15? I'd say no, I would not exercise an option to buy at a high price. So therefore my profit is going to be my payoff minus the cost, but the payoff is 0, so it's just going to be minus the cost. So that cost is going to be 5 cents per euro. Each contract is for 125,000 euros, and I'm getting 5 contracts. Euros cancel out, and that price turns out to be A, 31,250 negative, because it's a cost. Now the other way to do it is just mathematically. The profit of a call is the maximum of 0 st minus x times the quantity minus the cost times the quantity. So let's go ahead and fill in. So the maximum 0 st $1.15 minus the strike $1.30 times quantity minus 5 cents times quantity. Notice this 115 minus 130, that number is negative 0.15. So now we can look at this and say mathematically the payoff of a call is the maximum of 0 or the payoff if I exercised. 0 is greater as a maximum of these two functions, so 0 is greater than negative 15. So actually my payoff for this call is 0. In other words, I don't exercise. Therefore, it's 0 payoff times quantity minus 0.05 times quantity. Or we're back to the same problem, or same math over there, 0.05 times my 125,000 euros times 5. And that's my negative 31,250. So here's an example calculating the profit if you don't exercise, and it just turns out to be the cost. Or use your formula and let the maximum function show you you don't exercise. Here's a problem with a put. Suppose you buy 5 $1.30 strike puts. My quantity is 125,000, but I have make that a small Q of 5, so really it's 5 times 125,000 is my total Q. The premium, this cost, is 4 cents, and we're also looking for profit, not just payoff. And at maturity, the asset is selling for 125, the underlying. So I can set this up as a function, say equals the profit for a put is the maximum of 0 x minus st times q minus cost times q. So that's going to be the maximum of 0 x $1.30 minus st $1.25. That's 5 cents right there, times q minus the cost times q. Now in this case, the maximum of 0 or 5 cents is 5 cents. Or another way of thinking about it is I am going to exercise this option to sell the asset at 130. I'll purchase it in the spot market first for $1.25, and then I'll exercise the put and sell it for $1.30. So whenever you have this max function, you have a positive value, it actually means you exercised. So this function then becomes just 0.05 times q minus c times q. My c was 0.04 cents. Right, that's the cost. So I can rewrite that as 0.05 q minus 0.04 q. I can rewrite that as 5 cents minus 4 cents times q. In other words, the option cost me 4 cents, and then I exercised it and made it 5 cents. So I made on net a penny per euro times 125,000 euros times 5. Euros cancel out, and that'll give you a value of 6,250. Now profits of exercised options could turn out to be negative. Right? Think about this problem here where ST turns out to be not 125, but maybe one. Well, let's get one where we lose money. Let's say 129. So here's an option to sell euros at 130 when they're trading in the market at 129. Now I'm only going to make a penny in this problem, and since I made a penny by exercising but lost 4 on the premium, I'm actually going to lose 3 cents in profit, but I would have lost 4 cents if I didn't exercise. So that's an important thing to remember, that you forget about the sunk cost of this option when figuring out exercise. Or you just do it mathematically and it'll work out for you. Now let's do an example of hedging with currency puts and compare that to forwards. Suppose Dell has a 500,000 December receivables. In other words, in December, they're going to take possession of 500,000 euros. Now, if they don't hedge, and say the exchange rate goes to either 130 or 112, that's what the spot price goes to. If they don't hedge, that means they'll get $1.30 or $1.12 per euro. In other words, they'll make either 655,000 or 561,000 in dollars for that receivable. Now, we showed in the last topic that this firm could enter into a short forward to sell 500,000 euros at $1.2228, assuming that's the forward price. In that case, it wouldn't matter what the exchange rate is. If the exchange rate's 130 or 112, it doesn't matter. They are locked in because they can sell, or they have to sell the euros at 122.28. So they have a guaranteed revenue of 611,400 using a forward contract to hedge versus an unhedged position. Now they can also hedge this using puts. Let's assume they can get a 12228 strike put on 500,000 euros. All right, let's think about what happens now. Now they have the right Banaba obligation to sell their 500,000 euros at 122.28. So if the spot price turns out to be 131.15, they can either forget the option and sell them at the market price and get 655, or exercise the option and get 611. Well, it's quite clear they're just going to not exercise the put option, sell the accounts receivable at the spot market, and make 655. Now, if the exchange rate does fall to 112, they're better off exercising the 122 strike. In that case, they'll get 122 or 611,400. So the advantage of using puts or calls versus futures contract is you keep the upside. So in this case, my upside is the euro appreciates. Well, I keep that upside because I walk away from the option. But then in this case, I create a floor. The worst case is I'll sell all my euros at 122.8. And that's the way to think about a put option on euros. It's really a minimum or a floor price in which I'll get to sell them. But I can always walk away, right? If the euro goes to $2 a euro for some reason, I'll make $1 million up here. But if the euro goes to 10 cents a euro, right, for some reason the whole eurozone falls apart, I'll still make 611. However, this payoff, obviously it's better than this payoff, right? I'm going to get at least 611. I have to pay for that, and say, what if the price of that put was 1.25 cents? I'd pay 6,250 to have this payoff, this possible payoff. And that's the basic underlying rationale of using a forward versus an option. A forward costs nothing up front, but you lock exactly what the price is. An option is going to cost you money up front, but then you retain upside. Now you can unwind options just like you can unwind futures. It's actually a little bit easier to think about. Suppose you buy a Philadelphia Exchange June call options. Each one's for 62,500 euros, 90 cent strike, and the price of the option is 2.3 cents. Now that option is going to cost me some money. So let's see what the cost of that option is. 2.3 cents per euro times 62,500 euros. and we're going to buy 3 contracts. So the price of that option is $4,312.50. Now, after holding these options for 60 days, it hasn't matured yet, you go out to the Philadelphia Exchange and see that the options are currently selling for 3.8 cents. All right, so this is not the price of the euro. This is the price of a call option for June delivery, 90-cent strike is 3.8 cents. Well, then you can just sell the option for 3.8 cents. You're not exercising the option. You're just selling the option for somebody else that'll hold it to maturity. So let's figure out what your profit is. In this case, my profit from unwinding a call or a put is, if I buy it at 2.3 cents and sell it at 3.8 cents, I'm just going to make the difference. Whoops, that shouldn't say per euro. That's just the price of the contract. So I bought the option for 3.8 cents. I'm sorry, I bought the option for 2.3 cents. I sold it for 3.8. Looks like I'm just buying a penny stock for 2.3 cents and selling it for 3.8 times 62,500 is the quantity. So I'm just going to make the difference. And then what if we had some brokerage fees? Well, if you bought 3 contracts and you paid $5 every time you bought a contract from the exchange, and then you sold the 3 contracts and paid $5 for each contract when you sold, you actually had 6 transactions, 3 buys, 3 sells, and if the transaction costs were $5 each, you paid an extra $30 for a transaction. So in this case, your profit turns out to be $2,782.50. So this is a case where you bought a call for 2.3 cents, and before it ever exercises, you just saw a higher price, you just sell the call for 3.8 cents, and you make some money. So let's do a little review of options versus forwards and futures. An option, you have to pay up front for the right but not obligation to sell. Forward futures contracts, they have no costs. But there is a margin, which is not a cost, it's just a security deposit that you pay up front for futures. For a call and put option, once you own it, you can't lose money. Again, the sunk cost is the premium, but you'll never exercise it if it's going to cost you money. Whereas a forward and futures contract, you're going to lose or win, right? If you enter into a forward contract to buy at some price, all right, and it turns out you could have bought it at a cheaper price in the spot market, right, you're going to lose. So you could have negative or positive payoffs for forwards and futures. Forward and futures contracts, there's one maturity date, but you could unwind some futures contracts. For an option, if it's an American style, you could choose to exercise and buy for a call, sell for a put every day until maturity. For a futures contract, for each delivery month, there's one contract, and you either take a long position or a short position. So there's really just 2 positions on one contract. For options, there's calls, there's puts. You can buy the call or buy the put, or you could sell the call or sell the put and get that premium. Let's talk for a few minutes just about option valuation. Option valuation is actually a pretty difficult topic. It's difficult to value an option because the value depends on a lot of things. What's the strike? What's the maturity date? What's the price of the underlying? What are interest rates? And what is the volatility of the underlying exchange rate? Now, all of these factors are observable. So if you're trying to value, say, a 1-year option, you know exactly what the strike price is. You know exactly when the maturity is. You know exactly what the underlying spot price is. You know exactly what, say, 1-year treasury rates are. What you don't know is what's the expected volatility of the underlying exchange rate over the period of the option. And what it turns out is the higher the volatility, the expected volatility of an exchange rate, the higher the premium, that cost, is going to be because the higher the volatility of the option is, the more it could vary from current price. And if you have an option, as long as there's a chance it could be something different than today, that's going to be valuable. Now, the standard model to value an option is using the Black-Scholes. Now, if you double click on this spreadsheet, if you've downloaded, you'll see that there's an Excel worksheet inside here. And here are the inputs I would use for Black-Scholes. I'd put in, say, if we're trying to value a 125 strike at the money call and put on the euro, how I'd value that is, this is basically a stock. This is exactly a stock option valuation model, but I'm going to trick it to work with currencies. How I do that is under stock price, I'm going to put the underlying spot price of the euro. Then I'll put in the exercise price. And since I said it's an at-the-money option, they're both 125. This will be a U.S. Treasury rate, the risk-free interest rate. And the maturity in years, I'll say a 1-year option. Now, the only trick you have to remember for using Black-Scholes to value options is where it says dividend yield, put the foreign sovereign rate with the equal to the maturity date of the option. So if this were the euro, I would put in, say, the German 1-year sovereign rate, since it's a 1-year contract. Now, intuitively, why you do this? If I were to hold a stock, I would receive a dividend. If I were to hold a currency, I would deposit it in a foreign bank and earn their foreign risk-free rate. So it's really the income that's generated from a currency versus a stock. If I input all these things, Black-Scholes will give me a model price. In this case, it says, given these parameters, inputs, the call should be selling at 5 cents and the put should be selling at 4.7 cents. Now, the other interesting thing on here, we're not going to deal with these right now, but it also gives you a delta. Now, delta in Black-Scholes, you can think of it as two ways. It tells you how the price of the option changes with a $1 price change in the underlying. So in other words, if I made the current spot price of the euro $2.25, I would expect this option to go up by 52 cents. And that's how I interpreted the delta. And I expect the put to fall, but in this case, it can't fall to anything less than 0. Now, the other interpretation of delta, one interpretation is roughly the probability that the option winds up in the money at maturity. Now, for at-the-money options, all right, the absolute value of the delta is about 0.5. In other words, for an at-the-money option, it's roughly a 50% chance it's in the money. Now, in this case, why is it more than 50% chance of the call will be in the money? Well, it has to do with the relative interest rates in both economies. So in this case, U.S. interest rates are 1%, Euro are 0.75%. So I'd say, well, the Euro has less inflation, so the Euro is probably expected to appreciate. So that's why it's more than, say, a 50% chance that the call winds up in the money. But again, it's the absolute value is the probability it winds up in the money. Now, if you pick a really at-the-money option, this delta goes to about 0 because there's almost no chance. And the last thing we'll talk about is, if I look at my spreadsheet, there's something called an implied volatility. And what I first have to do is plug in something here. So I plug in this data here, and it tells me this call should be selling at 5 cents. But what if you actually go to the Philadelphia Exchange and see that this option is actually selling for 4 cents in the market? That's the observed call price. Well, given that, this calculation here of implied volatility, that will tell you what input you'd have to put into standard deviation for Black-Scholes to give you a price of 4 cents. So let me erase some of this. What that is telling you is if I were to make this number 7.78%, this price would be 4 cents. So an interpretation of this is no one really knows what the expected volatility of the option is. Now I can guess volatility based on, say, historical volatility, and it says that the option should be trading at 5 cents. But if I observe it's at 4 cents, maybe the market is really guessing the volatility 778. So the idea of implied volatility, it's the standard deviation, annualized standard deviation that you need to input into Black-Scholes to give you the model price of the market price. And it's been shown that this volatility is a good estimator of future volatility. Now, if the put were selling at 3.8 cents, if I made this number 8%, this put would go to 0.38. So you got an implied volatility for the call and implied volatility for the put. Now, one thing you should notice, that if you change these implied volatilities, if you increase these, it's going to increase the prices of calls and puts. In this case here, in which I had 10% and Black-Scholes was giving me 5 cents, but the actual option is selling for 4 cents, that implies that the market's estimate for volatility is less than 10, because I have to lower that 10 to lower this price. And I have to lower this 10 to lower this put price to get to 3.8. So there is a relationship that you should understand between implied vols prices and Black-Scholes implied prices. So in this topic, we talked about how to calculate the payoff of a call and a put using the cost and the payoff functions, max 0, st minus strike, and x minus strike, or x minus st for puts. We talked about how calls and puts could be used to hedge receivables or payables. Talk about how you could sell an option or unwind it before maturity by just saying buying it and then selling it. And then talk about the basics of valuing an option.